Good afternoon and welcome to the Primary Health Properties PLC Interim Results Investor Presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged. You can be submitted anytime via the Q&A tab situated in the right-hand corner of your screen. Just click Q&A, scroll to the bottom, type your question and press send. The company may not be in a position to answer every question received during the meeting itself. However, the company review all questions submitted today and publish responses where appropriate to do so. Before we begin, I'd like to submit the following poll. I'd now like to hand you over to Harry Hyman, CEO. Good afternoon.
Hello everybody, let me introduce my colleagues and myself. My name is Harry Hyman. I'm the founder and chief executive of Primary Health Properties. Richard Howell, finance director, is on my right. David Bateman, the chief investment officer, is on my left. Just before we start with the slides, I just wanted to give you a very brief overview of what the company actually does. We have a very simple business model. We buy properties, assets, which are let on a long-term basis to healthcare users in the UK, predominantly GPs and the NHS and pharmacy operators, and in Ireland, our other area of operation, to the HSE, which is the Irish equivalent of the NHS, GPs and pharmacy operators. And we derive the income from that, and net of all costs and our interest charges, we pay that out to investors in the shape of a dividend, which I'm proud to say has grown in each of the last 26 years. And if you were to buy the shares today, the dividend yield is something like 4.5%. So we have a very simple, very robust, low-risk business model. Having said that, now let's give you some highlights of our results before we drill down into the detail of the presentation. So clearly, just to say a few words at the beginning, we're fortunate to operate in a very good and growing sector. The good news is that populations in both Britain and Ireland are growing, they are getting older, and there is more incidence of chronic disease like type 2 diabetes, like drug and alcohol abuse, heart disease, and things like that, all of which put an enormous strain, as we know, on healthcare systems. And one of the best ways of dealing with that is to move a lot of the demand into the primary care arena. So gone are the days when the GP centre was just the doctor's house, where a single doctor or maybe two doctors practice. And the future is very much more the hub core primary centre, where a wide range of services and therapies are delivered alongside a large practice of doctors, 6, 10, or even 20 in some cases. So this is a very good way for governments to reduce the pressure on their healthcare budgets, and therefore we have a vibrant future ahead of us as a business. We all know the incredible stresses and strains that COVID-19 put on the healthcare systems, and that strain has not gone away, if for no other reason than we still have to carry on with the vaccination program for people over 50, and I can see that carrying on for quite some time. From our standpoint too, there is an enormously large opportunity to invest more in the primary care estate. Some 40% of it, according to BMA statistics, is not fit for purpose. And we've estimated that that is a total capital requirement of between 4 and 5 billion here in the UK, and in Ireland around €1 billion is needed to modernise the estate. We had a lot of talk about digital and the impact that that would have on medical centres, but so far our experience is that while the internal configuration some of the buildings is changing to take into account online consultations, the actual amount of space that's needed within the primary care estate is not reducing, but still increasing. Anyway, let's give you some highlights from our results that we came out with for the 6 months to 30th of June. We carried on with our track record of paying a progressive dividend. We've already paid 3.25p. We've announced the third quarterly payment, which is paid on the 28th of August, and we're on track for the 6.5p that brokers are predicting our dividend to be for the year as a whole. And our dividend cover is very good at 103% of the amount that we paid out. Our accounting return, as we'll hear shortly, is very strong at 6.3%, driven by a good accounting revaluation surplus, and our total property return also reflected that. We of course are conscious of the fact that there's a lot of uncertainty in the various marketplaces around the world, and we've taken a cautious stance towards acquisitions, acquiring 3 assets for 49 million during the period. We've also done some capital recycling, selling a portfolio of 13 assets for just under 28 million, which closed after the period end. We do have a good pipeline, which you'll hear more about during the presentation, and we're focusing very much on our own on-balance sheet development and our Irish opportunities. Many people think that we're exposed to higher interest rates and would be worse off from higher inflation, but in fact, we are 95% hedged out on the debt side, so the impact there will be very muted. And in fact, both through the combination of our index-linked income, where 25% of the portfolio is formally linked to inflation, but also through the way the rental mechanism works, we believe that higher inflation will lead to a firming tone in the amount of rental growth that we are getting. The first half saw an increase in the rent roll of some 1.8 million, in part from asset management opportunities and also inflation-linked increases, but also a firmer tone on the open market value reviews. We're seeing the benefits of some of the excellent refinancings that we did in 21 and the early part of 22. So our portfolio today stands at 2.9 billion. Our rent roll is 144 million. 89% of the total top line of the business comes from either the British or Irish government, balanced mainly from pharmacy operators. We have a portfolio that is almost 100% let, with a very long WALT outstanding of over 11 years. And as I mentioned earlier, most of our debt is hedged out for the next 8 years. Just to reinforce that point, here is a chart showing our track record of paying an increased dividend. When we prepared the slide, our share price is just under 144p, showing a 4.5% yield. And we have every intention of maintaining this track record from the financing of social infrastructure as we move forward. Looking at the relative performance of the business, on the next slide, you can see that we have done very well on a 20-year basis. We've done very well on a 10-year basis and a 5-year basis, and so on and so forth. And we believe that our returns are superior to that of our competitor. But we're not here to talk about them, we're here to talk about us. And what we have is a very dependable source of high quality growing revenue, which comes out to our shareholders quarterly in February, in May, in August, and in November. And we can be safe in the knowledge that we're helping play our part, not only in the levelling up agenda, but also in the modernisation of social infrastructure across the UK. So that is our overview. And with that, I'm going to hand over to Richard, our CFO, who's going to talk about the finances in a bit more detail. Over to you, Richard.
Thanks, Harry. Yes, just looking at some of the key financial highlights for the first 6 months of 2022. Net rental income was up just by £3.4 million. Very encouragingly, and we'll come back and touch on this a bit later, half of that increase came from rent reviews and asset management, where we saw an increase of £1.7 million in the 6-month period. And the balance came from acquisitions and developments that we acquired last year and this year, and they added the balance of the number. So after we knock off interest and administrative costs, we come down to our adjusted earnings, and this is a number we like to pay out to shareholders in the form of ever-increasing dividends. So that was up by £4 million, £44.7 million. That was driven by those two factors I just touched upon, but also interest cost savings. We delivered around £5 million of interest cost savings last year, so some of that starts to flow through to this year, which resulted in £1.1 million of interest savings in the first 6 months of the year, notwithstanding additional debt that we've drawn down over the course of the year to finance new acquisitions and developments. We had a slight increase in admin costs, around £500,000, which was down to additional staffing that we've taken on board to manage with the increasing size of the portfolio. So on an adjusted earnings per share basis, that equaled 3.4p per share. As Harry's already mentioned, that was paid out to shareholders as a dividend, going to 3.25p. We had dividend cover at a healthy 103%. Like-for-like rental growth, £1.8 million, or 1.3%. That was a record in the first 6 months of the year, and we're very pleased with that, and we'll come back and touch on that a bit later in the year. Harry's already mentioned we saw very strong revaluation surplus, just over £50 million. That was driven by two key factors. Half of it was the rental growth we've just touched upon, we've also continue to see a very strong investment market. We saw yields compressed by a further 7 basis points in the period. Investment property portfolio now valued at 2.9 billion. We'll touch on that a bit more detail a bit later in the presentation. Adjusted net tangible assets per share, just under 121p. There was up 4.1p in the first 6 months. 3.8p of that came from the valuation surplus, with a balance from retained earnings. Loan to value ratio, we like to leverage this portfolio relatively high compared to most other REITs because we have a very strong government-backed income stream. But it's at the lower end of our target range between 40 and 50%, and at 30th of June we were just above 43%. We also have £290 million of undrawn firepower from our various loan facilities, which was there to finance our pipeline, which we'll talk about again in a bit more detail a bit later. These other metrics Harry's already mentioned, pretty much fully occupied, long lease lengths, an average cost of debt down at just 3%. We also have the lowest EPRA cost ratio at just over 10% in the whole UK REIT sector. This next slide, we've touched on most of these key numbers, but this one pulls out the differential between our adjusted earnings, which we like to pay out to shareholders, and accounting numbers, which are called IFRS. So when you add on the adjusted earnings, 44.7, add on the revaluation surplus and some gains on our derivatives and convertible bonds, we saw a total profit of just under £108 million in the first 6 months of the year, equivalent to 8p per share. Looking at the balance sheet, we have adjusted net tangible assets just over 1.6 billion. They were up 3.6% in the period. Most of that was driven by the revaluation surplus. So what this chart is trying to show you that although the starting net asset value just under 117p rose from the adjusted earnings 3.4p, that was paid out to shareholders in the form of a dividend. The revaluation surplus increased that by 3.8p, and the other is just the premium in the shares which were issued through the scrip dividend mechanism. Turning to the debt portfolio, we have just under £1.6 billion of various debt facilities with a wide range of lending partners. There are a number of institutions. Aviva, very keen lenders to the sector. All the high street banks in the forms of revolving credit facilities, which provide a lot of flexibility in terms of when we have spare cash, we can pay the loans down, and we will need cash to buy acquisitions, we can draw it down. We also have a number of bonds and private placements, including euro-denominated borrowings, which hedge out our euro exposure in Ireland. That debt is fixed out for just under 8 years. As Harry's already mentioned, 95% fixed, so we have very little exposure to rising interest rates in the future. £290 million of undrawn firepower, which is there to finance our future capital commitments and our pipeline into the future. When you look at the chart at the bottom of that graph, this is just showing the maturity profile of our debt. We don't have any particular large waterfall, and all of the facilities maturing in 23 and 24 are revolving credit facilities with typical UK high street banks. Those banks remain very supportive of this sector. They're keen to lend more to us. We're in the process of renewing those facilities at the moment. These pie charts, or bar charts I should say, show the improving debt metrics across the whole of the portfolio. Average cost of debt is pretty much an all-time low, 3%. As already said, that's fixed out for just under 8 years. Interest cover ratio continues to improve as we save money on the interest costs, but our rental income continues to grow from acquisitions and rental growth. Loan to value ratio at the lower end of our target range. We will take that up towards 50%. But we prefer to be towards the lower end of our target range at the moment. And debt maturity just under 8 years. So at this stage, I'm going to hand over. I'll just touch upon our net zero carbon ambitions. So we're very keen to green the portfolio, and we want all of our operational developments and asset management activities to be net zero by 2030. Through our asset management program, which we'll come back and talk about a bit later, We are improving the environmental credentials of all of our assets, and by 2030, we want to get these assets to be at least an EPC rating of B. This is really to avoid a brown discount across the portfolio in future years, as obviously letting requirements become more and more stringent in the future. We also have a very key role to play in the social side of ESG, and all our properties are delivering well-being and healthcare for the UK and Irish populations, and around 9% of the UK population is registered at one of our properties. So at that stage, I'm going to hand over to David, who's going to talk you through the investment and development pipeline.
Thank you, Richard. Well, notwithstanding the outlook for longer dated interest rates, I'm pleased to report that this year we've been able to, this half year or this period, we've been able to deliver a £51 million revaluation surplus. And this has further been underlined by a recent sale of 13 assets at 13% ahead of the December 2021 book value, which obviously bodes well for our valuation. During the course of the period, and indeed just after the period end, we've acquired 3 assets for a total value of 49 million. They're listed on the presentation page, I think you can now see. And we like all of these assets, obviously, but particularly they've all got long leases. They've all got, 2 of the 3, have index-led, RPI index-led rent reviews. They all have strong underlying site values, and in 2 of the cases they are effectively government-backed income, and indeed in the third case, which is the Chiswick Medical Centre, the covenant of that tenant is extremely strong in HCA International. Looking to the rest of the year and the second half of the year, we anticipate continuing to make cautious but and indeed selecting further investments. Moving on, we are progressing our development activity. On-balance sheet development for us is relatively new, and we are proud to say that we have our first on-balance sheet development now on site, taking place at the Croft Medical Centre in West Sussex. Additionally, as well as delivering a higher yield on cost than we can generate from acquiring investments on the market, these assets allow us to bring forward cutting-edge medical centres with very attractive sustainability credentials, such as net zero carbon accreditations, BREEAM excellent ratings, and EPC grades of A. We have a growing pipeline of developments, one of which is listed on this slide in Spilsby in Lincolnshire, and we expect to have more developments on site during the second half of the year. The slide also briefly touches on 2 of our forward funded schemes that we have completed on in Ireland during the period, both of which recognise strong sustainable credentials, provide government-backed tenancies via the HSE, which is Ireland's equivalent of the NHS, and provide for index-linked rent reviews, further driving our net profit line. Moving on, and just picking up on the theme of those 2 Irish forward-funded developments that we've completed, we also plan to further our strategic expansion into Ireland. We already have 20 assets there with an approximate value of 200 million in sterling, and we have a pipeline there of approximately 43 million via 3 assets. The Irish assets provide us with an opportunity to acquire product at a higher yield, or should I say softer price, than we can generate in the UK, and indeed, similar to the UK, the vast majority of the income is government-led. I won't dwell too long on my final slide, which touches on our pipeline looking forward, but really I'd highlight here that we have a strong pipeline across all our core investment spaces. Effectively in the UK, to include development, we have a pipeline of 123 million spread across 12 assets, which includes our development pipeline, and in Ireland, 43 million spread across 3 assets, which are predominantly forward-funded schemes. I should also touch on our pipeline for asset management projects. This side of our investment in our infrastructure shouldn't go unnoticed, and during the course of the next 3 years, we plan to deploy approximately 52 million across 50 projects, whereby we'll be improving the buildings, lengthening the leases, and using that capital to generate higher rents. So fundamentally a positive picture for the portfolio, ensuring it's future-proofed. On that note, I'll hand over to Harry to provide some summary comments.
Thanks very much. But before doing that, I'm going to talk a little bit about the property portfolio. As you can see, it's a very granular portfolio. At the 30th of June, before making those disposals, we had 524 properties, with 20 of which were in Ireland. Interestingly, the net initial yield was some 4.57%, and the average lot size, which has increased over the years, is now some £5.5 million sterling. When you look at the income expiry profile of the 10.2 million, which is circled as being arriving in the next 3 years, the good news is that 80% of that has already had terms agreed or is in advanced discussion with the NHS tenants about renewal. It's extremely unusual for properties to come back. What normally happens is that we carry out an asset management project to improve the properties, both from an environmental standpoint, but also with a view to extending the lease. Our assets, the distribution within our assets is shown in the bottom half of the slide, and as you can see, we have a large percentage, a third of the portfolio is invested in assets valued at over 10 million, and only just five of the 524 are valued at 100 million. And this is one of the reasons that we rotate capital round, is in order to keep that size growing and remove the smaller assets, which in general have a higher degree of risk associated with them. I mentioned at the outset that the prospects for rental growth after a very fallow period of some years is beginning to look up, and that's driven by both inflation, actually on the index-linked leases, but also because the rent review process within this sector, it kind of follows inflation, because although 69% of the portfolio has got open market value reviews, what is an open market value review? Where the district valuer, an executive agency of HMRC, is responsible for agreeing the rent, and who are the alternative tenants? Well, the honest answer is there aren't very many alternative tenants, and therefore the open market value is kind of determined in practice by a proxy to indexed replacement cost. So you'll understand that as the replacement cost goes up, so the prospect for rental growth goes up too. Plus, we're spending more on our buildings now because of the need to have environmental concerns taken account of. We've heard about our first net zero carbon development, and all of the projects that we're looking at in asset management have as an important component of the work that we're doing an improvement in the BREEAM rating and the EPC rating for the properties. Just to pick on one at Ling, which is in West Bromwich, it's a fairly substantial building. We're spending 1.3 million and receiving a further £78,000 in rent, so a yield on cost of some 5%. There are 10 doctors in that building, but a vast array of other medical services, and it services some 15,000 patients. Following the project, the lease length will go out to 20 years, and the BREEAM rating, as you can see, or the EPC rating rather, will move to a B, and that is illustrated across the other 3 projects that are listed there. So in order to leave plenty of time for questions, let me just summarize what we've told you. There are very strong demographic trends behind this business. We are playing our part in the levelling up agenda by bringing capital into the less well-off parts of the country, trying to reduce the healthcare disparities. We have very strong prospects for rental growth driven by our 25% of the rent roll that is index linked. The government in Ireland and Britain pays 89% of the total rent roll, and we are gradually getting towards our £3 billion gross asset value. There's a lot of uncertainty in the marketplace, so we're taking a disciplined approach to further capital commitments in the second half of the year. We're likely to wait and see before doing anything radical and different for the rest of the year on into 23. So our strategy is very clear, and I think what we've got is a very defensive, predictable business which pays good dividends to our shareholders. So with that, I'm going to return to the moderator, who's going to deal with the questions.
Fantastic, Harry. Thank you very much indeed. And thank you to the team for the presentation. Ladies and gentlemen, do please continue submitting your questions via the Q&A tab situated just on the right-hand corner of your screen. Just while the team take a few moments to review those questions submitted, I'd like to remind you the recording of the presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard on the Investor Meet Company platform. We did receive a couple of pre-submitted questions. If I may, we'll start the Q&A session with those. The first one reads as follows: having recently listened to a presentation from a PHP competitor with an average development size of 7 to 8 million, I'm interested in knowing more about the average size of investment for PHP's new property developments and some views to the extent to which the future development model is for fewer but larger scale developments in the polyclinic style facilities.
Well, thank you for that. I think, is that question from Nick B, or was that a separate question?
That was a pre-submitted question.
Right, okay. I think the answer is that, firstly, I'd highlight that our average lot size now is circa 5 million. And as the portfolio is growing, it is logical to either seek to maintain or grow that lot size. As Harry had touched on earlier during the presentation, this isn't the case for all smaller assets, but indeed, certainly for some, the threat of obsolescence for smaller assets is perhaps greater. And it's in line with our strategy to invest in larger hub facilities, which will attract larger patient lists and be fit for the future in terms of housing more services as they come out of secondary care into primary care. So I think the answer is, in short, yes, we are looking to manage up our minimum lot size. Presently, that's about 5 million. And in terms of bringing our developments forward, as a generalism, really they are at that size and indeed larger. So I don't think that's going to change the spots of our average lot size in the portfolio.
I've actually rejected a couple of smaller ones recently because the size of the opportunity was too small for us.
Yes, yeah, absolutely. At both in terms of developments and investments. Yeah. So we're selective with what we buy. We like to ensure that it's fit for the future, and we like to believe that the assets that we're focusing on are those that are likely to see the best, the greatest patronage, and furthermore, the best rental growth opportunities.
Fantastic, thank you. The second pre-submitted question, I guess, really sort of a market question, but who are your peers? How are they faring? You know, who are the competitors? Who are the comparable companies in your space?
Okay, well, let me have a go at that. I mean, our nearest quoted competitor is Assura, which is very similar in size. It's been later into the marketplace in Ireland. It has a different funding strategy from our own, and it's got a greater number of smaller buildings due to the history and what they've acquired. And it's further along the piece in terms of development, with a bigger development pipeline than we've currently got. But actually, they're quite similar businesses. BlackRock have a 300-400 million pound property portfolio, very similar stock, but they're not interested in disposing of it. And there's a couple of private owners that have smaller portfolios. And that's about it. In Ireland, there's one other competitor has a similar sized portfolio to ourselves. But one of the difficulties of primary care is actually assembling a portfolio of significant scale. And over the last 26 years, the team has put together that portfolio, and that's one of the reasons why it's worth a premium, as indeed is the high quality income that is driven from it, its consistency, its predictability, and its durability.
Fantastic. Thank you very much indeed. That concludes the pre-submitted questions, and as you can see, we've had a number of questions that have come throughout today's presentation. If I may just hand back to you, just where appropriate to do so, to read out the question and give your response, please.
Okay, so the first question is from Nick. Thanks very much for this. What is the rationale for disposals from the estate when you have such great, I guess it should be properties? Is it to take development returns to further expansion? Well, I think whenever we have a portfolio, or if anyone's got a portfolio of stocks and shares, it's always a good idea to keep it under review, and where you see better growth potential elsewhere, to rotate that capital around. And that's what we did with the disposal portfolio, isn't it, David?
Yeah, we felt there that those assets, we felt firstly we could sell them for a strong price, which indeed was demonstrated by the premium to the December 2021 valuation, and indeed we felt we could rotate that capital into new assets, perhaps at higher yields, i.e. to generate more income with perhaps stronger potential to deliver better returns going forward.
Thanks. Shall we go on to the next question? This is from Ryan. With new developments, do the government put this out to tender for the build out of replacement sites that are fit for purpose, or are these new sites, and how is the development pipeline managed from that basis? Well, that's a brilliant question. As with everything with the NHS, it tends to be quite complex and can be driven by many different sources. Because GPs technically are not part of the NHS themselves, they're independent contractors. It's managed by the GPs, but obviously they need to get budget approval, which comes through a business case. Now, this business case is written by the GPs or their advisors, sometimes in conjunction within the old days, CCGs, but now independent primary care networks. And they will have a shortlisting process with 4 or 5 developers invited along, and they will pick the person who is best suited to their needs. So that's the first part of that question. In many cases, the requirement for new surgeries is not just consolidation, like our Eastbourne project, which you can see on slide 26. Maybe you can just flip to that quickly. So at Eastbourne, as you can see here, 3 older properties, which are converted residential, not purpose-built, have been scrapped effectively, dealt with by the developer, which was not us in this case. We forward funded this deal, and been replaced by a super duper £10 million surgery, or primary care centre really, with 20 GPs and a wide range of services. So that's one illustration of how new projects come about. But a much more common way is actually around new housing development. So the Spilsby development that we saw back on that particular slide is brought about because there's a large number of houses being built in Lincolnshire, and in particular at Spilsby, and the planning requirement is for a new medical centre to be provided, and we won the competition to become the preferred provider of that, working in conjunction with the developer. So it is a competitive process, which of course adds to the complexity and the time taken, but it's not as bad as being in a full-on competitive tender for the government, where the only real way of competing is on price. Here, specification is important, as is control of the site, and track record, and the standard of fit-out that goes into the building is also very important.
Thank you. That concludes the questions we've had so far. And if there are further questions, the company will be able to review those and we'll be able to publish responses on the Investor Meet Company platform. Yeah. Harry, before redirecting investors to provide you with their feedback, which I know is particularly important to you, if I could just ask you for a few closing comments, please.
Sure. Well, thank you very much. I think when times are volatile, somebody once said to me that PHP stands out as a beacon of stability. We operate in a sector which is an essential part of life, as we've discovered through the pandemic. Having a vibrant and good health sector is very important. That means there's no shortage of demand for our buildings, as you've seen. Because of prudent financial management, we're not overly exposed to higher interest rates. The inflationary tailwinds that people are so worried about are actually quite positive for our business. And we're determined and committed to carrying on with our 26-year track record of paying an increasing dividend. Stability, defensiveness, predictability, these are all great phrases to describe Primary Health Properties, and we look forward to playing our part in the modernisation of the healthcare infrastructure in the UK and in Ireland in a socially responsible and environmentally friendly way. And we're looking forward to being back with you and delivering a further update with our full year results in the early part of 23. Thank you for attending. We appreciate it and look forward to speaking to you all again.
That's great. Thank you very much indeed for updating investors today. Could I please ask investors not to close the session, as you'll be automatically redirected to provide your feedback in order the team can better understand your views and expectations. This will only take a few moments to complete and is greatly valued by the company. On behalf of the management team of Primary Health Properties PLC, we'd like to thank you for attending today's presentation. That concludes today's session, and good afternoon to you all.